Mr. Shoe and Mr. Hat both don't have any money. Mr. Shoe earns $100 and decides he wants to put it in the bank. Mr. Shoe finds a bank he really likes. Right now the bank doesn't owe anybody anything and it doesn't have anything. It's a brand new bank. Mr. Shoe opens an account at the bank and deposits his $100 into the bank. The bank creates a checking account for Mr. Shoe and writes down that they owe Mr. Shoe $100. The bank creates a receipt for Mr. Shoe and then gives Mr. Shoe the receipt along with a checkbook so he can access his money, along with an application for a debit card so he can access his money just like a credit card. According to the rules in the United States, the bank only has to keep $10 to cover the $100 it owes to Mr. Shoe. So it sets $10 aside as its reserves, and the excess reserves, the other $90, are available to lend out to borrowers. After talking with the bank, Mr. Hat decides that he can go into debt up to $90 and pay back interest to the bank. The bank helps Mr. Hat to produce a promissory note that Mr. Hat will be giving to the bank in exchange for some cash. Mr. Hat signs the promissory note and gives it to the bank. The bank then creates a matching account for Mr. Hat in the amount of $90, which it owes to Mr. Hat. The bank then creates a slip to recognize that Mr. Hat has $90 in the bank. The slip of paper is given to Mr. Hat and the loan creation process is complete. A close look at the situation shows that the bank owes $190, $100 to Mr. Shoe and $90 to Mr. Hat. The bank also has on hand $100 in cash and a promissory note from Mr. Hat to pay the bank back $90 plus interest. Things balance out, and in effect, the bank has slightly more than it started with since it has the promise of interest payment from Mr. Hat. When we look outside the bank, we see that Mr. Hat believes he has $90 as deposit in the bank, and Mr. Shoe believes he has $100 as deposit inside the bank. It appears that $190 now exists. So from $100 in cash deposited in a bank, a fractional reserve bank that has a 10% reserve requirement, in other words it has to keep 10% of the money, $90 can be lent out and the money supply expands by 90%. Instead of having $100 in cash, we have now $190 in deposit money. Where did the extra $90 come from? The extra $90 essentially came from Mr. Hat's promise to pay the bank back $90 plus interest. It's money that's being drawn from the future into the present to back up current money that's being used by Mr. Hat and by Mr. Shoe. In order for Mr. Hat to access the $90, he simply brings in the proof that he has an account at the bank and he asks for his $90. The bank is left in a kind of difficult position. Since the bank traded the cash for the promise to pay, and since the bank already had a promise to pay, those two cancel each other out and can then be eliminated. Now if we take another look at a bank, we see that the bank owes Mr. Shoe the same $100, but as backing the bank only has a single $10 bill and a single promise from Mr. Hat to pay back $90 plus interest, but sometime in the future. While this may appear like an impossible situation, this is exactly the situation that almost every bank in the United States is in at the moment. This works because it's not just one borrower and one depositor at this bank. In reality, there are hundreds of depositors and hundreds of borrowers. If we think of Mr. Shoe as representing all the depositors, having deposited $100 million in the bank, and we think of Mr. Hat as all the borrowers having borrowed $90 million from the bank, then we can see that $10 million is probably sufficient to satisfy all the needs of all the depositors. At this point, Mr. Hat spends his money, and we see that the soundness of the banking system rests entirely upon the borrower's ability and willingness to repay the entire amount of the loan with interest in the time frame required. If the borrowers can't or won't, then the bank is in serious trouble, as are all the depositors. For more information, search the internet for fractional reserve banking. For localfuture.org, this is Aaron Wiesner.
If students want an overview of the book in one course, they still would very much enjoy Principles of Economics, right? Principles of Economics is the single course that we have available as an independent study course, where you covered sort of the most important ideas in the book in one course. Other students who maybe they're homeschoolers, or maybe they really want to spend a lot of time to just dig through thoroughly go through the whole textbook, then this series of courses would be for them, right?
Right, yeah. So that previous course, what was titled Principles of Economics, don't get me wrong, I think that was a great course. I mean, the professor was phenomenal in my opinion. So yeah, by all means, if people want to go look at that because they don't have the time to spend 3 courses, that's still there, and I think that's great for what we did. But the point is, as you say, if you really want to go through and basically there were a lot of material in the textbook. Let me put it to you this way: when I was writing the textbook, I had this thought in my mind saying, what if this is the one book somebody reads on free market economics in his or her life? What needs to be in this book? And that was the criterion that I used as to what material to put in and what to exclude. And so given that it was almost causing me physical pain in the Principles of Economics Mises course, where I just realized I just can't cover this. And I was hoping they would go on their own and do the reading. And so that's now the point of doing this 3-part series, is that to say, instead of hoping and why don't we go through and carefully do it, because there's so much in here that people need to know if they're being introduced to economics in particular. And I want to just make sure they catch all those important points of all the stuff that's in that textbook.
Mm-hmm. Now, in this textbook, you cover Austrian economics principles, but these are also principles that they would find in other economics courses, wouldn't they?
Right. So it's a good issue you're bringing up. We didn't want Lessons for the Young Economist to be an explicitly Austrian book, because then I was afraid general homeschoolers who tend to be sort of right wing or conservative, and that's the way they might think of themselves, and they might not. It might sound like it was some obscure thing if they saw a textbook that was explicitly billed as this is Austrian economics. They might say, well, I don't even know what that means. And so that's why the Lessons for the Young Economist per se is just trying to be it's a general free market introduction to free market economics. But of course, I think any Austrian reader would like everything that's in the book. It's not that there's anything non-Austrian in there, and that's partly too. It's, Milton Friedman's famous thing about, there's not Austrian or this or that. It's just good economics and bad economics. And I agree. And I think Austrian economics is good economics. And that's why I'm an Austrian. I don't go out of my way to do something I think is wrong. So everything in there is Austrian, but we didn't try to, make it that explicit. We just, I was billing it as this is free market economic analysis. So the difference, though, in terms of what we're going to be able to do now with these Mises Academy courses is I can – if there's a particular point in the textbook that we cover, I can now have the freedom, since we're teaching it through the Mises Academy, and I know the people who are signing up are going to be coming from that background and they have that level of interest, I can fill in the details and talk about, this is what Murray Rothbard had to say on this issue and so forth. So things that were just a little bit too much inside baseball to get into the textbook, I can sort of give that flavor and explain this particularly Austrian contribution on some particular issue.
So this won't be just a tutorial through the textbook. There'll be a lot of extra value that students will get from the lectures, because they'll be getting a lot of distinctly Austrian information and theory through the lectures, right?
Right. And I mean, that's, at least to me, that's kind of what the point of a lecture is, that ideally – this is how I conducted my classes at Hillsdale College, where I taught for 3 years, and then what I do with the online courses here is, the lecture has to be standalone in the sense that I know some people are, especially if they're adults who are working, they just don't have time to do the reading, and they just want to tune in, and that's what they can afford to carve out of their schedule. And so the lecture does have to be able to stand alone, but the most value someone's going to get is if they do the reading first and then tune into the lecture. And so because of that, I make the two dovetail each other, that I'm not merely just basically reading from the textbook or giving a book report on Lessons for the Young Economist. What I'm doing is giving an independent lecture that is based on the same type of material. So yeah, to answer your question, someone who just read the textbook, they're going to get a lot more from these Mises Academy classes based on it. And in particular, they're going to get a lot of anecdotes and other sorts of things that Austrians have said on these topics to sort of give them a broader range of education on what the Austrian take is on these issues.
And but there will be a lot of sort of tutorial aspects to the course. One of the most challenging things about working through a textbook is to really get the message out of graphs and charts. And one of the things that I've really enjoyed in watching your previous Mises Academy courses, especially when you're covering this book and when you're covering Man, Economy, and State, is that you walk the student through interpreting tables and charts. And so you have a cursor floating on the screen that all the students can see while they're watching the live broadcast or watching the video later, and you're circling different parts of the table and guiding the student's eye from one part to another and just holding their hand through it so they can really understand it. Is that something that you enjoy about online teaching?
Yeah, definitely, and that just come from my experience teaching in the actual physical classroom, that I realized you can give students reading to do, and there can be tables and things in there, and they can even have read it, and you just realize talking to them, or like you give a quiz the next day with some of the cells on the table not filled in, and they don't know how to put them in, and you realize, oh man, these they just don't get what the table's saying, and it's partly because you just, as the professor, you assume, well, they've been reading about this their whole lives. They know exactly what the context is here. And then you got to say, well, no, if this is the first time you've seen this thing, you don't know really what's going on. So yes, that is, I think, one of the things that's one of the functions of giving a lecture based on something that the student ideally has read before, is that if there's something like that, you can walk through it and really make sure they understand, how is this table working. And so that's why, if it's the things that are in this book, since I wrote it, I put in there because I thought they were important. So there are a few places where, just to give a specific illustration, things like comparative advantage, and when does it make sense for somebody who's really good at two tasks to hire somebody who is inferior in the absolute sense, but yet it still is efficient, to hire somebody. So the classic example of the lawyer hiring the secretary to do some of his correspondence, even though he's a faster typist. That can make sense. Or the doctor hiring nurses to take the patient's blood pressure before he meets with them, even though he's better at taking blood pressure than the nurses are. Things like that, where it helps to illustrate that concept with a specific numerical example. So yes, where we hit that part in the book and the lecture, I'll walk through that to make sure the students really get where those numbers coming from and how do you read this table.
Mm-hmm. So even Superman and Jimmy Olsen, that they have incentive to divide their labor in exchange.
Right.
A man who thinks we're on the edge of economic Armageddon. He's Jonathan Davis, and he argues that markets are finally catching up with economic realities. And of course, the last 2 days have seen fantastic losses on the stock exchanges of the world. Very bad data out of the United States in the week. Virtually frozen level of growth in the United Kingdom, and the potential collapse, at least at the periphery, of the Eurozone. It's all a very ill-starred configuration. Let's get some light from Jonathan, who's an economist and a wealth manager. Jonathan, welcome to the show.
Hello again, George.
Please summarize for us how you see the situation.
Governments all around the world, whether left and right, are doing the exact same as Japan has done in the 90s and the 2000s, and bailed out insolvent banks, borrowing money from, shall we say, the Mr. and Mrs. Watanabes, and literally handing it to the banks. Governments in the West have been borrowing from the banks and handing it back to the banks to bail them out for previous reckless loans. In other words, we're in a sense doing exactly the same as Japan has been doing for over 2 decades. Japan has been in depression for 20 years. Their stock market is down 80%. Their house prices are down 70%. You should see, God knows, the number of suicides in Japan. We are in depression now. And you know, this stuff about if you borrow more money, then you can get yourself out of problems. Well, I'll tell you what, America's deeply in the mire, and it's borrowing more than anyone else.
Indeed, and has been downgraded, at least by one of the credit rating agencies. Were you surprised that the consequences of that were not more severe?
What you mean with regard to the stock market? Or what
No, well, I mean, when that downgrading occurred,
Yep.
I mean, in a way, it's epochal, isn't it? It's one of the most significant things
absolutely.
that's ever happened.
It's the
But the
first
political
time.
class has sailed on regardless.
Well, of course they do. That's what politicians do. You should know that. It's the first time in history that the government, which has the global reserve currency, the dollar, has been in any way downgraded. But come on, let's not give any credence whatsoever to the American ratings agencies, Standard & Poor's, Moody's, and Fitch. These are the guys who were giving AAA left, right, and centre to mortgage-backed securities, and so on. And these were the guys who were giving Bank of Ireland AAA. I can go on.
Yeah.
The fact is, the economic system is shot to pieces, and we are in a depression. Let me remind you, in 1931, they didn't know then. They were in the biggest depression in history. In 2011, people don't see what is in front of their faces. The UK, when you consider all the debts that the government has £5.5 trillion of debt. Add on to that £1.25 trillion of household debt. There is no way that you can get out of this without societal and economic pain, because of the vast amount of debt weighing on everyone's shoulders.
Well, the debt is one issue, and I know you're particularly hot on that, but the lack of growth, the kind of stagflation that we now have, inflation way above the bank's target, way above the government's target, yet people, and it's going to get worse, in really dire financial and economic circumstances, unable to keep their jobs, if they're in jobs having their pay frozen, maybe even cut, their public services savagely reduced, throwing even more people on the dole. Did you say rubbish?
Yeah, there's no savage cuts. You look at you of all people, an intelligent, sophisticated politician, you should know that the amount that the government is spending is more than last year. The cuts haven't even started yet, hardly.
Well, we're about to enter the equivalent of a nuclear winter. We're about to see unemployment.
And I'm agreeing with you. You introduced me as the guy who's going to tell the nation listening that we're in economic Armageddon. We are. But it's because of all the borrowings that successive governments have undertaken, stretching right back to Thatcher. It has just increased, whether you're left or right. And you know, for those to say a couple of years ago that they saved the world because they borrowed vast amounts of money and handed it to the bankers and they punted some money into the economy, they didn't save the world. What they did was...
He did save us from the euro, though.
Massive problem.
He did save us from the euro.
Well, so... What's happening in Europe?
Well, you say so.
Well, I'll tell you, it bears no...
Jonathan.
No benefit whatsoever, because you said it yourself, the cost of living is soaring and aggregate income is not rising. So whether you're in the euro or not, it doesn't matter.
Well,
we are in the economic mire just like every country in the West.
Well, I'm agreeing with that, but if we're going to single out Gordon Brown, it's equally right to say that if it had been left to Tony Blair, we would have been in the euro. If it had been left to Nick Clegg, we would have been in the euro.
Well, I'm agreeing. Look, it doesn't matter who it was, whether it's left or right or centre. All the politicians at the top of the tree in whatever country have made the wrong decisions. And, you know, you're talking about the high cost of living. You're talking about the lack of aggregate income rises. You're talking about unemployment. I agree with you, but they're making the wrong decisions. They're keeping interest rates too low for too long. So what they're doing is they're bailing out profligate lenders and profligate borrowers. They should hike the interest rate now. That would cut the import costs of fuel, of food, of heat, of light, of transportation, and that would reduce the cost of living to the average man and woman in the street.
Except it would put another million people on the dole, and it would put 1 million people into the repossession courts with their houses being taken off them.
How interesting that you're interested in people who have borrowed vast amounts of money to buy houses. You're sounding like you're sounding like a right winger now.
I don't want to see them on the
George,
street.
Let me answer the point. I agree with you. Hiking interest rates would have a short-term detrimental effect for the economy. It would have a couple of years of problem, no doubt, and a lot of people would have a problem. However, long-term, and I'm talking about after a couple of years, with our much lower cost of living and cost of manufacture, we would become the most attractive nation on earth into which to invest. The only people who are truly benefiting from the low interest rate policy are the bankers and the politicians and the estate agents. Well, I'll tell you, if they went down my route, A, stop bailing out banks, and B, hiked interest rates and a couple of other things, we would have a short, sharp shock to the system, but then we would have 20 years of growth.
Didn't we go down your route, Jonathan?
20 years of depression.
Didn't we go down your route in 1931?
No, we did not. That was an entirely different situation. That's what you guys are always talking about. In fact, the 1930s, the important thing about the 1930s is that we are actually broadly going down the same way that they did then. The only difference is that the level of debt that we have in the economy is bigger than what it was in 1929. So, do we really want a third world war? Is that the way out of this problem, for goodness sake?
Well, God save us from that. I'm only letting you go because you've got yet another interview to do, because you're a good man to argue with. That's Jonathan Davis, economist and wealth manager. I don't know how to characterize his arguments, but I would characterize them as the economic orthodoxy of the nuclear winter of Philip Snowden, the Chancellor in Ramsay MacDonald's government, and the advocates of return to the gold standard and savage cuts in public expenditure. It'll be short-term, pain, even blood, he says. Of course, he will not be himself feeling the pain nor shedding any of that blood. And it's always easier to call for pain when it's other people's pain.